Good afternoon, everyone. We'll give everybody just a couple of minutes and then we'll get started. Hope everybody's gonna get ready for um, holiday weekend. Be fun, hopefully. A lot of golf in my future. Weather's not too hot down here for us anyway. It's all relative, right? Um, and today I got a lot of stuff to go through, so we're gonna go at 2:02. It's 2 o'clock right now, according to my clock, and then we'll get going. Um, we're going to talk about life insurance isn't about death. It's about control while you're alive and control, like just kind of beyond the death benefit. Then we're going to talk a little bit about um, whole life versus UL, and probably in particular IUL, because that's kind of the hot thing out there. People are saying, hey, should I do infinite banking with IULs? Because gosh, these illustrations look good. And the illustration is, especially with IUL, is not something to make a decision off of. And I'll go through why. Nelson was very against it, by the way. So that typically tells me everything I need to know. Um, and there's definitely a reason why he's against it. Let's see. All right. And then maybe what we'll do is hopefully we'll have some time. I'm going to try to save a little bit of time for questions. All right. So let's just give everybody 30 seconds. Okay, let's go ahead and get started. So life insurance isn't about death, it's about control. So I'm just looking at my notes. It's really a mental reset because when most people hear life insurance, they think about death, which is kind of funny. It's kind of small thinking because death benefit is a blessing, but it's not the bullseye, especially with infinite banking. And the bullseye is what properly structured dividend paying whole life policy unlocks. The bullseye what it unlocks while you're alive. And it's access to capital on your terms, right? This is the basis for infinite banking. Compounding debt, you don't interrupt because when you take a loan or something, you're taking the insurance company's money while your money stays in there and grows tax free and grows uninterrupted, guaranteed. So, compounding that you don't interrupt and the ability to borrow against that money to be the bank in your own life. That's the first mental reset. We got to get that infinite banking reset. And then your premiums build guaranteed cash value, right? Guaranteed. That cash value is contractually guaranteed to rise every single year. And mutual carriers may add dividends. The ones we use have paid dividends for over 100 years. And you can collateralize that value and borrow against it to fund real estate, businesses, equipment, leases, and then recycle the cash flow that comes back to your policy. No approvals, no banker, no mood swings, no interest rate swings, like that. I mean, there can be fixed and variable loans, but they're always below market. Just math and contracts, right? And I was talking to this real estate agent the other day, and I couldn't get him to understand the math of even at 5 or 6%, why I wouldn't have a mortgage on my house because I can go make more than 5 or 6%. And he goes, yeah, but the emotional. I'm like, what? No, my house is a liability, and you trying to tell me that it's not um, is a problem. Okay, so why do these guarantees matter in this whole life policy? Well, they matter because guarantees matter when you're the bank. Banks run on reliability. If your capital is unpredictable, your deal flow dies. Whole life gives you, if again, if it's unpredictable, like in this IUL where it can go up and down, then your deal flow dies. And whole life gives you guaranteed growth, level premium, stable death benefit, the boring trifecta that makes everything else work. The big picture is you're not chasing returns inside the policy. I'm using the policy to control capital and I hunt for returns in the outside, out there in the real world. Okay, so the other thing is the durability of the policies. I'm going to show you in a few minutes, but whole life is sticky. And what I mean is you get it and it stays. The lapse rate for whole life policies are actually going down and universal life policies are rising. And one of the reasons that there is a lapse ratio is there are people out there telling people they shouldn't have whole life, they should have UL, right? So that's a problem. The other thing is real world stressing or stress testing. What I mean by that is life gets messy. You're gonna have layoff, recession, rate swings, whole life's contractual guarantees and low lapse. It helps you get through those cycles. Nelson always said infinite banking is great for emergencies and opportunities. And then again, UL and IUL have almost a double the lapse ratio than whole life, right? Whole life isn't sexy, but neither is rebar. And if you're building a skyscraper, you'll want rebar, right? I mean, you want it. You need that stability in that just those guarantees. And just like I said, just make it boring. I don't want ups and downs, and I don't want to call clients and say, "Hey, guess what? The cost of insurance is going up," because that doesn't happen in whole life. So kind of some ground rules before we start to compare these products is infinite banking is not an investment in the policy. Just remember that. It's a financing system built on guarantees, and getting the chassis right. You got to get the chassis right, and then you go buy assets. Keep your rate of return brain for the deals and keep your guaranteed brain for the banking engine, the wealth engine, right? And okay, so everybody's probably heard of universal life, index universal life. They're all in the same chassis. So I want you to understand that. Variable universal life, index universal life, they're on the same chassis. But IUL is the popular one right now. And index universal life, or IUL, is a flexible premium. So that's one of the ways they sell it. In a universal life policy whose credited interest is tied to an index. Doesn't mean they're going to put your money in the index. It does not mean that. There's a formula, though. You have cap rates, participation rates. The cap and participation rates can change. Did you know that? Most people don't. The cost of insurance rises with age. So what do you think happens is while your insurance cost is rising, if your investment doesn't rise, if they change the participation rate or the cap rates? Big problems. So the cost of insurance can rise, but your performance depends on moving parts that you don't control. What is infinite banking all about? Control. Regulators have to rein in rosy illustrations over and over again. There's AG 49, AG 49A, AG 49. All of these things are regulations that say, hey, you can't do it that way. You guys are doing it wrong. You're trying to make this look better than it is, because they're talking about potential. This is the policy could potentially do this. Whole life, you have two columns, guaranteed and current market, meaning current dividend. That's fair, because I know worst case scenario, and I know that, hey, if dividends are about the same as they are now, this is what it looks like. The other thing is just off of potential. Here's what it might do. And here's why we think that, because the index has done this, blah, 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 blah. But they are not taking into consideration cap rates, participation rates, insurance costs. They're not, okay? So why does all of that matter for infinite banking? Well, banking needs certainty, guaranteed accrual, predictable loanability, and high persistency. IUL offers potential crediting, not guaranteed accumulation like whole life. When cap rates fall or cost of insurance rises, projected values compress. That's fine if you're speculating. It's poison if you're counting on the policy as your permanent lending base. I just got off the phone today, and I don't think he's on here, but with a great client who is, I don't know how many policies, really, we just reviewed 4 of his policies. And he's like, I need to expand because I mean, he's using it, and the math is just dumb. Like what he's paying for the money and what he's earning on the money. It's just awesome. So, um, again, you need a permanent lending base. So here's kind of the actuarial scorecard. Okay. And this is from a study 2009 to 2013. Is universal life was twice as likely to lapse somewhere along the line. Okay. Then in 2015 to 2021, Limber did a study, and it was the UL exposure. Okay. And it was up to $4 trillion of face amount. But if you have all of these lapses and surrenders, then they never have to pay out a premium. And did you know the term policies less than 1% ever pay out anything? So again, the exposure for these insurance company, it goes down when there's lapses. Yes, they don't have the money to use anymore or whatever the value was, but they normally lapse without value because the insurance cost goes up. That's not going to happen to you when you're 30 or 40 or 50, maybe late 50s, around 60, 65. That cost of insurance goes way up. And if you're outside a bucket of investment performance, what's tied to the index doesn't go up too, then they'll just lower your cap rate or your participation rate. And then you're in trouble. So Munich Reinsurance, and then one of the largest ones, they flagged a pattern saying that lapses running so much higher than whole life can increase from the 10 years onward. And that's exactly when the owners of the policy need stability. And think about how efficient the whole life policy is at that point. So actuaries are waving the red flag. And there's a study in 2024, there was an advisory that says here's the risks that are about misestimating policyholder behavior has already driven block underperformance. This is from an insurance company. So that block of business is underperforming. So now they don't assume that buyers keep these policies forever because many don't. So what actual percentage of IUL policies are in place and force at death? Well, I mean, here's the honest answer is that there is no credible published lifetime to death percentage yet for IUL. Well, why is that? Because most IUL blocks are too young to observe end-to-end mortality experience. Did you know that? Whole life's been around for 300 years. And actuarial consultants, there's a company called WTW, they warn ultimate persistency may be far lower than pricing assumed. That's the quote. And lower than whole life for sure. And 80 to 90% of indexed, this is from a consumer advocacy group of indexed universal style policies, 80 to 90% will fail to persist, meaning for the whole life of that person. I mean, think about that. This is not definitive, but it's a worry. Like, hey, they're worried. And if a UL or IUL block of business averaged less than 4% lapse, or around even 4% lapse every year for 40 years, only about 20% would still be enforced. And the way that you calculate that is well, I guess I don't have the math of calculating it, but you consider the shock to that block of business. And that's why I don't build a banking system on it. There's a reason why these policies lapse. And you start to see illustrations and it's like, wait a minute, this thing's going to run out when I'm 70. Well, yeah, you're 60, so you got to die in the next 10 years. Whole life policies go to 121. guaranteed, right? Pay the premium, guaranteed. So also there's a loan lapse. Let's go back to the illustration for a second. This whole AG 49, 49A, 49B, they exist because illustrations can overpromise. It says it right in there. Caps, participation rate, loan arbitrage, multipliers can all be dialed by insurers or restrained by regulators later. Your banking system should not rely on moving targets. It shouldn't. Okay. So here's another thing: loans. UL and IUL with loans can implode if crediting underperforms costs. So if your investment isn't doing as well as what the cost of the loan and everything is, and then if you lapse, you could get a taxable gain if you have outstanding loans. That's not a risk you want to have in your banking system chassis. I mean, there are a lot of guys selling a lot of this out there right now. It's crazy. Okay. But you're buying cash flowing assets, and you got consumer advocacy, you got regulators, just a general consumer warning saying, hey, could be a problem. So within your operating system, in your banking system, whole life just again equals guaranteed cash value growth, level premiums, okay, meaning the cost of insurance does not go up, historically low lapse, dependable collateral for asset buying. Those are all the requirements. Now, what IUL and UL, what they would say is flexible premiums, variable crediting, higher potentially, and duration sensitive lapses is what they call it. That means, well, if you keep it too long, I still want the death benefit. Unreliable collateral for a banking engine, right? Because of these moving parts. In the whole life chassis, you overfund base plus PUAs to the non-MEC design, right to the MEC line. You build up early cash value and keep it compounding uninterrupted. You borrow against it to buy cash flowing assets. Use the cash flow to repay the loans, repeat, rinse, repeat, rinse, repeat. You're not trying to win the market inside the policy. You're building a permanent guaranteed line of credit to go win outside the policy, because you get both. It's an and asset. You get the money inside the insurance contract, and you get the money in the investment, the asset, right? You get both. So if you're serious about building wealth and buying assets, pick guarantees over potential. Whole life is the rebar. IUL is the roller coaster. One builds empires, the other one sells tickets. And I think that's a great way of looking at it, because that's how people sell it. So, again, I was just talking to this guy. He was getting like 30% cash on cash return, and his loan cost him 4 or 5%. I mean, I just said, how much money you want to put in that? And he goes, as much as they will let me. And that's, I mean, and this guy, by the way, did it by the book. He put in 4 years PUA on every policy, didn't skip, again, he has consistent cash flow. So I know some of us, I've done it. I put more in 1 year, less in the next year. I'm just saying he did it by the book, everything through it, right? All right, so let's just kind of wrap all of this up. And, I don't know about you guys, but I'm like excited about the long weekend for some reason. You'd think I would feel like every day was a weekend down here in Florida, but our golf course opens back up next Wednesday, so I'm kind of getting excited for that too. But let me just kind of recap some of the things. Is twice the lapse rate, UL the whole life, the exposure of the block of business where it's not going to be profitable. So if something's not profitable to the insurance company and they have the ability to change cost of insurance, cap rates, participation rates, do you think they will? They're not going to lose money, right? And it doesn't happen the duration. So it's around year 10 with some portfolios that they start to see this happening, because about 10 years in, people are like, oh crap, I bought the wrong thing. This marketing, where's that marketing guy? He's not around anymore, right? Then you got NIAC, which is the National Association of Insurance Commissioners. You have the AG 49, AG 49A, 49B saying, hey, we got to tighten this up. These illustrations, they're not real. So, here's the bottom line is, this is like, let's just kind of go back to remember the whole thing is the misconception. Most people think life insurance equals death. That's the wrong target. Death benefit is a blessing. It's not the bullseye. The bullseye is the living benefits, guaranteed cash value, loan access, financial control while alive. Whole life is your bedrock. It's your rebar. Guaranteed growth, rises every year, no guesswork, level premium, no surprise hikes as you age, stable death benefit, doesn't shrink late in life, right? I mean, because again, the death benefit can go down with UL too. Low lapse rates, over 90% of whole life policies remain in force long term. And it's an infinite banking fit, reliable, predictable, permanent line of credit to buy cash flowing assets or expenses if you want to do that too. Okay. I mean, the bottom line is, guess who gets to decide? You do. Now let's go back to Index Universal Life. Market link crediting. You know what's going to happen in the market? Nobody does. It's the returns are tied to the S&P 500 and the formulas, but they're subject to caps and participation rates and insurer discretion. What about the insured discretion? No, you don't have any say. All the moving parts, the cap, the cost, the illustrations, often overpromise. I gave you those three times that regulators had to step in and change it. Higher lapse ratio, and the persistency for actuaries and insurance companies, it's a problem. Around year 10 plus, long-term persistency is uncertain and they don't survive until death. Many don't, 80 to 90%. You really want to buy that? It's only been around for 40 years. They don't even have the studies. Or not 40 years, 50 years, 1980. Yeah, a little bit more than 50 years, all right? No, 80, almost 50 years. I went to public school, remember? Just kidding. So IBC principle. You don't chase returns inside the insurance policy. You build guarantees inside the insurance policy, then you chase returns in real assets. It's the rebar. It's your wealth structure. IUL is the roller coaster. Don't gamble on potential. That's what IUL is. Build on guarantees. That's what whole life is. Death benefit is the cherry. Banking system is the cake. You can't have your cherry and your cake. Be the bank, control the money, build the game. That's the bottom line. That's the bottom line is, like, I hope you guys see that because like sometimes I say something and I've said it so many times that I visualize it moving in these parts, right? I visualize the policy. I visualize what we're doing with it. On this side is my protection. It's my guarantees. I make sure all of that is working right. And it's my backup for when I make a mistake. Oh, I buy a property, it's not cash flowing. I get a capital call, whatever it is, right? This backs me up. My bank and having liquid cash backs me up. And over here, I'm doing the due diligence. I'm partnering, if I want to do it passively, with people that I know, like, and trust. People that have track records, people that have unique systems, people that have figured it out. And all they're looking for is to take money, my money, make money. They get to keep some, right? And if they're syndicating or whatever. But what you'll do if you're like Glenn and a lot of other people on this call is you'll find your niche. Mobile home parks. My dental hygienist today was asking me about this manufactured home that you can buy for $200,000 and it's renting for $2,400 a month, right? In the worst time, in season, $4,000, one bedroom, $4,000 a month in season. Okay, now what I say is show me those books, right? Show me those books. I just want to see that it is doing that. If it is doing that, I can make this thing work. So that's like her first property. I mean, I'm excited for her, right? Her first loan against her policy to go buy this property. And she could do it all from cash. She could do 20% down payment and have the seller finance it. The seller's like 75 years old. They don't need the money. They're just looking for cash flow and they don't want to have this anymore. So many opportunities. So I don't think we have any questions. Let me just make sure. No. Um, chat. No, no questions. All right. Well, everybody, I don't know. Hopefully that was helpful because maybe I showed you something on the whole life that people didn't know from before is, but we pound that. Nelson pounded that into us, right? I mean, I remember spending so much time talking to Nelson about whole life and why whole life and the miracle of whole life and why it's been around for 300 years. Tell me other products that have been around for 300 years. I'm not sure there's a lot, right? I mean, banks, I guess, have been around. Banks and whole life. Hmm. There's funny that banking with whole life would be a concept 300 years later, right? Two things that have survived. So anyway, thank you all. Godspeed. I hope you guys all. Wait a minute. Okay. Yep. Yep. Can you give some other examples of the type of assets policyholders can invest in for cash flow? Absolutely. Um, I've used it for hard money lending. I've used it for equipment. Okay. When I say hard money lending, I'll lend it to my companies. I just loaned 200,000 to one of my companies for 12%. Okay. So it cost me 4% in that policy. It's an older policy and I'm netting 8%, right? I mean, that's pretty good. Am I going to get 8% sitting in the bank? Nope. And by the way, guess what? My money's still sitting in the insurance contract. I'm just using the insurance company's money for that 200 grand. So that's one, just hard money lending. There are people out there that are doing the Burr method, buying distressed properties, rehabilitating, re-renting, refinancing, rinse and repeat, right? So just doing it over and over and over again. And equipment. I brought up the dental assistant. We have, I don't know how many dentists out there, Brian, that are using their cash value and the insurance company's money to go buy their operatories. Like the chair you sit in, the fancy TVs, and all the equipment that you're sitting in, and the little how they the where they operate on you or do clean your teeth and all that. So there's so many things. That's why it's infinite. But I don't know if that helps, Brian. Let's see, type of asset policy. Yeah, real estate, businesses. I've used it for all of these things, hard money lending, loaning it to your companies for equipment, or I loaned my company, one of my companies was low on cash, and we had a customer go out of business that owed us a bunch of money. So we thought we had that money coming in that month. They just closed their doors. $22,000 or $30,000. Okay, we need $15,000 or something to cover payroll. All right, I'll loan the company the money. Okay, so Becky says, I almost bought an IUL from Transamerica about a year ago, but it just didn't feel right. All the caps, participation rates, no real guarantees, and the numbers just didn't add up to me. So glad I didn't make that mistake. I am so glad you didn't either, Becky. I mean, I see it all the time. I even had two of my guys that are tied to Create Tailwind, but kind of loosely, right? That they've assigned to us. And they were like, hey, would you have a problem if we sold IUL? And I was like, yeah, I would. And here's why. And then I went through in even more detail than today, and they said, okay, we're not going to do that. And Nathan says, glad I was able to sign in, but need to re-listen to this. Was working while listening. Well, I understand, so we got to work sometimes, right? But I'm trying to get you guys to where you don't have to work. But no, and yeah, these things are recorded. Listen to it. If you have questions, email me, JimOliver@createtailwind.com. You want me to go into further detail about IUL? I mean, hopefully I gave you enough information. I can go as deep down this rabbit hole as you want. I can give you actuarial data that will put you to sleep. Now, I just look at what we said. It's a gamble. I don't want to gamble. I'm not a gambler. Won't be betting on the football games this weekend. right? If there was one I knew that where they were going to win, which how would I know? I don't, right? That's gambling. You're gambling when you buy IUL, you're gambling in the stock market, and you're gambling with the government if you have money in a 401k or IRA, because you don't know how much money they're going to take from you when they start taxing you, and they won't tell you. That doesn't seem right, right? If you're going to go buy a business, you want to know everything about that business. And then, hey, I'm fine paying you what it's worth. That seems fair. So anyway, we're right at 2:30, bumping up against it. So thank you all for being here. I really appreciate it. I really value that you guys tune in. Next week, we'll have another 30 minutes of information. If you have other topics you'd like to hear, or like Brian asked about like more examples, I mean, we can do a meeting for 30 minutes of just like 2 examples sometime. This is your community. So just reach out to me and let me know what you want to see, or reach out to Heather@createtailwind.com. Brian says, let's do it. Brian, I'll get it on the schedule. So thank you all very much. Godspeed, and we'll see you next week.